we're back, guys. So as you know, we haven't really recorded one of these podcasts since July last year.
It has been a long time, so it's good to be back. We've got new digs, new setup, and I have to say, you guys have done really well. God, it looks fantastic.
Yeah, it's looking good, guys. So we're going to continually try to improve what we're doing with our podcast. We're going to get back into it now. COVID lockdowns are over. We're back in the office, so weekly, even maybe a couple of times a week, you're going to hear from us, giving you some market updates, giving you some insights into what we're thinking about markets, stocks, and where things are likely to go next.
Absolutely. And if you want to hear us ramble about just about anything market related, put the topic down in the comments. We'll try and touch base. We do like to read them. So even if you just want to say hi, shoot us a comment.
Absolutely. We're going to share the podcast around everybody that's on our trading desk as well. So as you know, you've got me, Tim Michaelides, you've got Sam Green here today. Next week, it could be Michael Cornups, the owner of the business, could be Caro. So it's always going to mix it up with a few different advisors. So you're going to get some different opinions. Sometimes we're going to be talking about trading. Sometimes we're going to be talking about investing.
Yep, absolutely. Absolutely. And in this episode, we're going to talk about inflation and interest rates.
Yes.
It's something that I feel quite strongly about. In fact, I've asked for a fairly provocative title for this video. That's essentially the whole narrative around inflation at the moment. You know, we're hearing energy prices, petrol prices, oil prices skyrocketing. And so apparently that means that we need to lift interest rates. Well, I think there's a real risk in doing this, Tim. I think, you're basically saying, well, there's prices rising in one thing. It's not due to super low interest rates. In fact, it's rising due to a supply side issue. And so you're going to try and deal with the supply side issue by stopping supposedly strong demand. Well, this is a recipe for stagflation, I think, that we've got brewing. And it's really, really worrisome that as soon as you get supposed inflation, the narrative shifts completely to monetary policy.
Absolutely. And there's so much to unpack in this, like, honestly, between the supply chain issues of COVID and then also supply chain issues of the whole Russia-Ukraine situation. They're separate conversations, and there's going to be, for that to be resolved, there's various things that have to happen, right? So markets in particular, I think, are just going to be watching this so closely over the next few weeks and months to determine whether it's going to get worse or not. I think we've seen the worst of it, but I seriously think other investors and traders that are out there at the moment still think this is going to get a lot worse.
Yep. Well, look, it's an interesting thing, but obviously no one can really know what will happen with the Ukraine-Russia situation. No one can really know what will happen with supply from unconventional oil and gas extraction in the US, for example. But there's certain things that are a bit more predictable. We're seeing OPEC start talking about bringing supply online. We're seeing, the US rig counts start increasing quite dramatically. And, historically, oil has been quite price elastic. Mm-hmm. When there are spikes, you do get people like OPEC increasing production. You do get more marginal US unconventional production coming online. And that's what we're starting to see. So it is something that hopefully will eventually correct itself, but it's not going to be helped by a lift in interest rates. No. Michael Cornups, our colleague, often talks about, low interest rates essentially being deflationary for some products. And oil and gas can be, a good example of this, because if you're a very marginal cost producer and your cost of borrowing goes up, you're discouraged from producing more oil.
That's right.
So at higher interest rates, that may lead to a reduction in supply rather than an increase in supply, which will just send oil prices up further. So look, I really do think that the whole narrative around let's ratchet up interest rates as quick as we can to supposedly deal with this inflation is completely missing the mark. And like I said before, big risk of causing stagflation, which is a situation where you're still getting inflation, but you're getting economic growth contracting or getting an economic contraction. And that would be the worst case scenario. That would be the worst case scenario for the global economy, especially one that's trying to recover from the COVID situation still, that's trying to deal with the situation in Ukraine. And, the COVID situation is still there. We're getting parts of China going back into lockdown, and that's going to further this supply side factor for a lot of products.
That's right.
And again, a lift in interest rates isn't going to reopen those provinces of China. So I do think that the mainstream media narrative is a very dangerous one at the moment.
Absolutely. And it looks like the Fed's just sort of playing the game of saying what they feel the market wants to hear, right? So the bond markets themselves had well-priced higher interest rates in before the Fed even changed their narrative. Right, so I think bond rates were indicating a move to 1.8 to 2% by the end of the year before the Fed even opened their mouth.
Yep.
Right, so who's leading who here? Right, I kind of feel it's the market that's led the Fed to change their narrative, or else the market probably would have kept falling because what happened in January, the market just fell out of bed, right? And most of that was before the whole Ukraine-Russia situation started, and it was all around interest rates because the market could see the inflation was getting out of control and something needed to be done. That's what they wanted. And then all of a sudden the Fed changed their tune from transitory to, hang on, the economy's really strong, we better do something here. So now, it's funny because the market kind of has now reacted positive to more of a hawkish Fed. And I don't think people really realize what's coming longer term out of this, right? Maybe they do, but they're just trading short term. I don't know. But when I've done my research into markets and interest rates, markets tend to go up while rates are going up, right? And it comes down to the old, where's the money flowing? Okay, because if interest rates are perceived to continue to go up, where do you want your money? Well, it's not in the bond market, is it? Right? That's obvious. Anyone that knows about bonds, if you own a bond and interest rates are going up or perceived to go up, you're going to lose money out of your bond. So you're moving into equities, into commodities, into crypto, wherever you want to move, but it's not going to be in bonds. Now, the Fed doesn't have to do anything here, right, for markets to react. As soon as investors believe that interest rates have topped, that dynamic's very quickly going to change and money's going to flow out of equities and straight back into bonds again. And I think that's going to happen sooner rather than later. And I'm still talking maybe a year away, year and a half, 2 years away. But for this year or even for the next 2 or 3 months, depending on what happens in Russia and Ukraine, take that out of the situation for a second, markets could be fairly bullish here as rates go up. And the rhetoric is that interest rates are going up. That should be bullish equities, right?
Mm-hmm. Yep.
So we're going to try and wait to see where that dynamic changes. And that's where the risk is for the market, I believe.
Oh, absolutely. Absolutely. And you're spot on. There's a lot of dollars out there. There's a lot of money that's been created through credit creation, through government borrowing across the last few years. And you're right. If bond prices are falling because yields and interest rates are rising, that's bonds being sold. That money has to go somewhere.
Correct.
We've seen some pretty stellar rebounds in our market, in the US market, across the past couple of months. And, there's cash out there. There's money out there.
Yeah.
It's got to go somewhere. And it's been going, back into equities.
So when do you think the RBA is going to move?
I think they'll probably move in May, just preceding, because we got the start of the month, the US goes in the middle of the month, preceding a double interest rate rise from the Fed. So I think the Fed's going to do 50 basis points in May. I think we'll do a 0.25% in May, just ahead of that.
Yeah.
And the reality is they can't differentiate too much from US policy. It dictates the borrowing costs of our banks. It's going to dictate the movements in our government bond yields regardless.
Yeah.
Despite that, our inflation is not at the same headline levels that US inflation is at. In fact, pre-GFC, pre-coronavirus selling, I should say, the RBA would love for a higher inflation environment. They would love to see, inflation in the target range. And our inflation, according to, headline CPI numbers, is just inside the target range, at the top of the target range.
Yeah.
We would have loved to have been able to buy this a few years ago. And now, it's apparently the worst thing ever. But yeah, I actually think in the medium to longer term, it'll be a good thing.
Well, for one, we definitely need some ammunition back in that barrel, don't we?
Yep.
Right. Otherwise, we're going to keep having to lean on QE and other forms of monetary policy to try and boost the economy when needed. Right. So yes, we are in a recovery mode coming out of COVID now. People are finally getting out of their houses. They're buying. The housing market's going nuts on low interest rates. So yes, there is sort of a bit of a boom phase here. So there is a good time to lift interest rates. The dangerous thing here for Australia, I believe, if they go too hard too quickly, right? A lot of people have bought houses over the last year or so. First home buyers finally getting into the market. And then all of a sudden rates go from, variables probably about 2.7 at the moment for most people. If that jumps to 4, guys, that's going to blow a few people out of the water and really harm the economy. So the RBA is going to have to be really careful here on how quickly and how much they raise rates by. It's very different to the US. Most people in the US lock their loans in for 30 years. You go jump on a US bank website, you'll see 30-year fixed loans. In Australia, the furthest we can really fix is 4 years, maybe 5. Right? I think Commonwealth Bank, when I looked last time, was 4 years fixed. Now, the 4-year fixed rate now, even with the RBA not moving, has jumped higher than the variable rate. Where go back a year ago, most of the fixed rates were lower. So in the fixed world, this is already priced in. It's the variable guys that I'm worried about.
Yeah, it'll be an interesting thing. I think a lot of people will have fixed their mortgage rates or borrowing costs going into this. It's been on the cards for some time, and in the short term, I think that it's forecast to hurt banks' lending margins, hurt their net interest margins. But in the longer term, after here in Australia in particular, those short-term fixed rates have passed, you're going to get those net interest margins increasing again. So in 18 months, 2 years, maybe 30 months, I think we'll start to see those funding margins or those lending margins from the banks increase again. Markets are forward-looking beasts, so in a year, I suspect that's when the analysts will be talking about looking at financial stocks for increasing their margins.
It's interesting to look at the banks on the back of this because they've all had a nice rally over the last 4 weeks or so. Commonwealth Bank up at 107, sitting at 22 odd PE.
Crazy move.
Big movement. Very expensive bank at the moment, but it's going to be interesting to see how the banks perform over the next few years and what happens with interest rates and in regards to banks.
It will be. I think we're looking at 1 or 2 bad reports from them. 1 or 2 reports with a bit of a contraction in their margins, and then I think the narrative will shift and profitability will start increasing again. So that's not where I'd be parked for the time being. I remain, absolutely a materials guy. Great value on our market. Price is extremely strong. Like I said, you're not going to cause an increase in supply of materials by lifting interest rates. If anything, supply will decrease. And big fan of metals. Metals.
Look at those prices, eh?
Well, absolutely. And what we're witnessing here is another supply side issue. Unlike oil and gas, which can be brought online pretty quickly, it takes years to build a metals mine. I mean, if you go from exploration to actually mining, you're looking at least 3, 4, 5+ years, often a lot longer. And what we're seeing now is really a consequence of the big drop in mining investment from about 2014 to about 2017. It wasn't just here in Australia, it's all around the world. And in the next few years, you're going to see huge shortages as a result.
And look, there's definitely a demand side there too. Coming out of COVID, everyone wants to go into infrastructure spending. So the demand, and even to talk about the whole move to green energy, the demand for many of these metals and rare earths are just going to be nuts over the next 20 years, right? So yeah, the timing of them cutting back on investment in the materials space for these miners, well, wish they had predicted what was to come, right?
Yeah.
But they haven't, right? So yes, we actually do have a strong demand in this space too, and yeah, like it should perform extremely well in the next 20 years, given all this move to green.
Absolutely. So yeah, aluminium, copper, nickel, zinc, tin, the rare earths. They're all forecast to do well. I think we'll see iron ore prices hold up really quite well in the near term, with steel production impacted in Ukraine and Russia. But it's really hard to look past copper and aluminium. And if we had to give one stock pick, I think one that we've traded in the past in the copper space that's come right back to a really attractive price would be Aeris. Yep. Aeris Resources. So that's one we're keeping a very close eye on. They had really good drill results the other day. They were a bit overpriced 6 months ago. Now I think a lot more attractively priced.
Yeah, awesome. All right, so we know, guys, look, value stocks towards materials and miners, metals, that sort of thing is probably our favourite. For me, least favourite at the moment in the short term, if the view of inflation is going to persist, is actually more the discretionary type stocks. I think they're going to underperform for a little while now, especially as the everyday consumer gets squeezed. If loan costs are going up, if costs, as you know, petrol's above $2, veggie costs, food costs, everything's going up, right? So I think people will have to become a little bit more conservative with their spending over the next 12 months. Mm-hmm. That's fair to say.
Yep.
So some discretionary will suffer here.
Absolutely. And a lot of discretionary stocks, or historically they've been quite expensive as well.
Yeah.
And not a time for expensive stocks. No. Not a time for expensive stocks.
And maybe some of this is priced in, especially in the US market, right? And NASDAQ's still hanging near its lows. That had a fairly large correction of recent. So I think some of it's priced, guys. But moving forward, if the market is going to run a bit more bullish, it's going to be the value space. I think that's going to really outperform in the next 12 months.
Absolutely.
So, and to say that, there is some stocks like Microsoft that is in that discretionary or tech space, that to me is a value stock. Mm-hmm. So I think we've got to sort of shift out of this whole group of all NASDAQ stocks or growth stocks. I think if you're trading the US markets and investing in the US markets, you got to look at it. What's a long-term company that has got consistent growth, that has got a well-established product that's likely to continue to do well? Right? Because to me, Microsoft's a staple, right? Who doesn't use Microsoft in their daily lives, work lives? Most people are moving to 365 for their whole suite of things for their business. They're the stocks I believe you want to be in right now, right? And hold them for the next 5 years while all this inflation issue plays out, because I think that's your safety, that's your defensive.
Oh, absolutely. I think operationally, it's been a masterclass from them. The 365, you're right, moving to the sort of more subscription-based models. They've knocked it out of the park. Yep. And great company, no longer super expensive. You're right, a bit of a staple.
And you say the same thing about mining and metal right now, right? Everybody needs copper, right? So get behind those companies that are going to be delivering good production targets and good prices. So.
Yep.
Yeah. So that's kind of where I'm at for my investment over the next couple of years. I want to be in stocks that are well proven, making money, profitable, and likely to continue to grow some profits over the next few years.
Yep. Conversely, your pipe dream rocket ship stocks,
not
likely to do particularly well in the coming sort of 12, 24 months. So, if you are that way inclined in your investing, I suggest buckling up and, getting ready for, you're probably feeling it already. So I don't want to rub it in too much.
Awesome. All right. I think we might start wrapping things up here. So I hope you enjoyed today's session, guys. As we said before, we're going to continue to do these on a weekly basis. So if you have a certain topic you'd like us to talk about, or you want to comment about what we've spoken about today, please use the comment section. Reach out, send us an email if you like. Happy to hear from you, and give us some suggestions, guys, of what you want to hear about.
Absolutely. And look, if you disagree with me or Tim, tell us in the comments. I mean, we're not so steadfast in our beliefs that we won't listen to anything else. And if you think we're wrong, let us know. And we'll take on board what you have to say. So.
Absolutely. Well, we're traders at the end of the day, so we're happy to change our view on a dime if we need to,
exactly.
right? So
we're not politicians, got no qualms in changing our beliefs. So, yeah.
Good stuff. All right. See you on the flip side, guys.
Thanks,
Bye
guys.
for now.
Bye.